there everyone, it's David Barnett from the investlocalbook.com blog site, back with another viewer question. This time we have a question from Brian, and he says, based upon your experiences, what experience could you tell me about with reference to a mature product or product category, which upon review you significantly grew the product's sales? How did you do it? What marketing strategy and action plan did you incorporate in order to be successful? It's a very interesting question. And I can tell from the question that maybe Brian is involved in a mature market or product category, and that maybe growth has started to stall, or maybe the margins are starting to shrink because as growth in a particular segment starts to slow down, the competitors who still want to grow market share start to cut into their margins, and everyone starts struggling basically to make sales that produce lower and lower profits. So let's stop and just take a moment, and I'm going to draw out the dogs and stars of the Boston Consulting Group. It's often called the BCG Model. So down here, and trust me, it's been 25 years since I worked with this, but if I remember correctly, down here we have profitability, and here we have growth. So here's high growth, and here's low growth. Here's low profits, and here's high profits. So we divide this in four. And if you have a business that is a low growth, low profit business, then they refer to this as a dog. So if you were running a conglomerate company and you had a lot of different businesses under you, this would probably be the business that you would not want to reinvest your money into. If you have high profits but low growth, then this is what we call a cash cow. So a business where you just have to maintain things, keep things operating, they go day by day, and you make a lot of money doing it even though nothing really exciting is happening in there. You don't want to give that away because it's producing a lot of profits for you, but it's also not a place that's going to grow. If you have high growth and high profits, then these are your stars. So this is a place where if you have limited resources within a big company, you can invest more money into your stars, and this is a place where you're going to get a bigger bang for your buck because it's growing quickly and it makes a lot of money. Over here, high growth, low profits is kind of a question mark. And I think that I got my axes reversed because I seem to remember things being in a different order. But you get the general idea. And they require further analysis because they're growing, but we can't seem to make any money at them. So are we going to do this or not? Now let me relay to you my own experience. Now, I was not a decision maker when I spent my career with the Yellow Pages, but I lived through exactly what you're talking about in your question, Brian. Because in the Yellow Page business of the 1970s, let's say, it was a high growth, high profitable business. They had a large margin and they were growing very quickly. They were a fantastic media through the 70s and 80s because business owners could basically buy one advertisement, get it into every home, and be there when people wanted to reach that kind of business. So they were growing very quickly and they had a very good margin. By the time that I joined the Yellow Pages at the end of the 90s, that business had moved down here. It was a lower growth business, but it was still very profitable. It was a cash cow, okay? So we still had minor price increases every year. We managed to grow the revenue a little bit every year, but the margins were significantly huge that we were making a lot of money. Nowadays, since the internet has grown, that Yellow Page publishing business has probably migrated over to here, where profits are reduced because sales are probably declining. I've seen copies of the Yellow Pages come out that are thinner and thinner. There are fewer and fewer ads in them. So their sales obviously are down. So it's got low growth or negative growth. And I would imagine that the profits have declined. And it's a public company now here in Canada, and I think that they have had some issues over the last few years about profitability and restructuring. So businesses in and of themselves can move from one place to another over the course of time on this Boston Consulting Group matrix. Now, here's the thing. If you said you have a business that is in a mature market, which means we're low growth, so it's either a cash cow or it's a dog, one of these two, depending on the profitability. The question is, how do you change that? And the answer is, I don't think you can. I don't think you can change that. What you need to get your head around is that there's a difference between businesses and companies, okay, and corporations. Corporations can be in more than one business. So the question that I would ask you, Brian, is what other businesses can your company get into leveraging the sales force, the distribution, and the customer base that you already have? Let's look at some examples of that. In the business of Yellow Pages, when I was there, the writing was clearly on the wall that the internet was going to be moving the Yellow Page publishing from a cash cow over to a dog. So what the company management did is they started to introduce internet-based advertising products, which was in the star section. It was high growth, high profitability. There was hardly any cost associated with it. And it was a place where people were interested in advertising. So when I went out and called on people to put their ad in the phone book, I would then say to them, here are ways that we can publish your ad online, help you get a better position in the Google search rankings, etc. So we were actually in two different businesses, but we were trying to leverage the same sales force and the same client base so that we could get into a business that was up here while our main business was down here somewhere, okay? You see the same sort of thing happening when you go to a gasoline retailer. The oil companies are very big and profitable, but fuel retailers are in a commodity game. An individual gas station owner or someone who has a chain of gas stations, they're making a few pennies per liter of fuel that's sold. So what do those guys do? So the fuel business, fuel retail, would be low growth, especially when there's an economic downturn, and low profit. So it's kind of a dog. But what you do is you take advantage of the traffic created by the fuel sales and you try to sell people convenience store items, which are bigger profit. So you're in a fuel business and you're in the convenience store business. And then maybe you decide that you can add some quick service restaurant offerings that are trendy or favorable, and that becomes a star. Again, you're leveraging the same physical location to sell to the same customer group, but you're actually in three different businesses. You're in the quick service restaurant business, you're in the convenience store business, and you're in the fuel retailing business, all in one corporation or company. So my advice to you would be to figure out who are my customers, what other things do they want to buy, what are my salespeople able to do, what is my distribution system able to handle, and can I introduce another business using the same resources that I have today and sell things to the same customers I have today. Thanks a lot. If you enjoyed this video and you want to see more just like it, why don't you come down to investlocalbook.com and be sure to sign up for my email list. Thanks. Have a great day.
Hey, you made it to the end of the video. That's great. Don't forget, visit www.investlocalbook.com. Sign up for my email list. It's right down here under the welcome video. Thanks, and we'll see you next time.